A company announces record profits, its highest quarter ever. Its share price drops 8% within the hour. That should make no sense to you. The company made more money than ever before, and the market punished it. Why would good news ever cause a stock to fall? Here is the uncomfortable answer. The stock market does not react to what happens. It reacts to what was expected to happen. This idea has a name, the efficient market hypothesis, and it was formalized in 1970 by an economist named Eugene Fama, who later won a Nobel Prize partly for the work. Fama's theory argued something that sounds almost too simple. A stock's price at any given moment already contains every piece of public information about that company. Not most of it, all of it. The rumors, the analyst predictions, the leaked hints from executives, the whispered guesses from traders. By the time the actual news arrives, the market has usually already priced it in. Think about what that means in practice. Every analyst on Wall Street expects a company to report a 20% profit increase. That 20% is already baked into the share price weeks before the announcement. So when the company actually reports exactly 20%, nothing happens. The price barely moves. That number was already old news the moment it became public, because the market had been trading on the expectation of it for weeks. But if the company reports 15% instead of the expected 20%, the price falls. Not because 15% growth is bad. Growth of 15% is genuinely excellent by almost any historical standard. The price falls because it is worse than what the market had already bet on. Traders even have a phrase for this, older than Fama's paper by decades: buy the rumor, sell the news. The pattern is remarkably consistent. In the weeks before a big announcement, speculative buying pushes a stock up as expectations build. Then, the moment the real number is confirmed, even a genuinely good number, the people who bought early start selling to lock in their profit. The rumor was the opportunity. The news is just the exit. This is also why a single sentence from a company executive can move a stock more violently than an entire earnings report. A rumor is pure expectation, completely untethered from any confirmed number, so it forces every trader to instantly reprice the stock around a guess. Confirmed news, by contrast, mostly just resolves a guess that markets had already made. There is a darker edge to this too. Because expectations move prices just as much as facts do, trading on a rumor you obtained unfairly before it becomes public is illegal in most of the world's financial markets. It's called insider trading, and the entire justification for banning it comes back to Fama's theory. If you know something material before the rest of the market does, you are not investing. You are stealing a head start that the efficient market system assumes nobody has. This is also the entire reason companies host a public conference call the same hour as their earnings report, instead of simply publishing a number and staying silent. The number alone tells the market nothing about whether it was better or worse than expected. Executives have to talk, guiding analysts toward what to expect next quarter, because the market is not really pricing the company. It is pricing everyone's best guess about the company's future, updated in real time with every sentence spoken on that call. None of this means markets are perfectly rational. Fama's theory has been challenged for decades. Investors panic, herd, and overreact constantly, and entire fields of behavioral economics exist specifically to study when markets get the expectation wrong. Bubbles happen. Crashes happen. Expectations can be collectively catastrophically mistaken. But the basic mechanism holds up remarkably well, and it explains something that confuses almost everyone the first time they watch a market. Profit does not move a stock price. The gap between profit and prediction does. So the next time you see a company post its best quarter in history and watch its share price fall anyway, you are not watching an irrational market. You are watching a room full of people who had already bet on something even better. Now you know.